Well, Jake, thanks for coming on the pod.
Me.
Excited to learn more about you. Excited to learn more about Opto. To start, would love to hear what was your most interesting story looking back at Bridgewater as a place to work in your early 20s?
Yeah, a lot of good stories. I think part of this is informed by it was my first job out of college, and so I didn't know what normal was. And so you land there.
And you were UChicago?
Yeah. And you land at Bridgewater, every room is recorded 24/7, and you have these, they call baseball cards. You're constantly giving quantitative feedback on about 300 metrics, conceptual thinking, linear thinking, but also honesty and curiosity.
Yeah.
Looking back, that is interesting and kind of strange, but it felt natural. So it was all I'd ever really experienced.
No part of you was like, "Oh, this is weird."
I think I knew at some level, but I've usually been my harshest critic, and so it didn't sting. Even the bad feedback was sort of not as negative as I might be about myself, and so it didn't. There were definitely people who came there. Often it was, you got straight A's in Ivy League. No one had ever told you were bad at anything, and within your first week, you haven't changed how Bridgewater invests. My view was that would be really scary if I could, in 1 week, change how a 40-year old hedge fund was addressing investments. But some people, did not like that as much. You learn a lot about really how markets work pretty quickly, and they bake a lot into your first year training to really build that intuition. But I think one of the best examples of that, they run an annual race. The headquarters is basically on a little island in a pond, and there's a bridge you go over to get there. And every year there's a race that's a mix of running and swimming, basically around the office, called the Scrum. And I figured out very quickly I was not going to win that race. There were triathletes and the prize was first class round trip tickets anywhere in the world. People competed hard.
Yeah, people wanted it.
But what was much more fun is opening up betting markets on the people. And so you'd do recon, you'd figure out, who had been getting in good shape for this. And because it was a bunch of hedge fund people, you weren't just betting on first, second, third. It was time split between first and third. And
so you created the book for the Scrum?
On some of the markets, yeah. And, it'd been around for a while, but every year someone would try and make new markets and find some light arbitrages. And you could find things between that person's supposed to be first, second, third, but then the diff between those two people was supposed to be less. So when we close that gap.
Yeah.
So from some fun applied
very
trading sites pretty quickly.
Yeah.
It's week 3.
Prediction markets before polymarket and Kalshi.
Yes, yeah. Some proto prediction markets betting on your colleagues' athleticism.
Yeah. Semi-easily observed, maybe, depending on how much you talk to them.
Try and follow them to the corporate gym,
Yeah, what are they doing? Is that guy putting up 225 or what? Okay, so Bridgewater was your first place out of school. Even UChicago, right? Let's talk about that experience. Did you go specifically to study economics? Do they even do they have a pre-graduate business program? Well, why UChicago coming out of SF, where obviously tech dominates the conversation?
And I'll say I actually think it was a mistake.
Okay.
I think there are people maybe it's the right school for. I don't think it was that for me, and I think there's a reason there's not a ton of founder community out of it. And maybe things are changing. It's been 10 years or whatever. But what attracted me was they do a really deep focus on the classics and a core curriculum. And I was teaching myself Latin and reading a lot of ancient philosophy and liked that approach. I knew I was going to study economics. It's one of the premier programs. What I didn't know going in was just how impractical that program was. And so obviously, birthplace of the efficient markets hypothesis, a lot of very deep math. You're basically doing a physics degree in, areas that I ended up believing that didn't apply. You were implying false specificity, false granularity. And markets are much more dynamic systems than that. And so a lot of the early Bridgewater was unlearning a lot of the solve for the steady state premia stuff I learned at UChicago. On the plus side, though, I think, being in an environment that didn't quite match my approach and thinking style was good practice for being a contrarian. And that I think does serve you well in the tech community. And I love the classics degree. I did economics and classics. Classics was great. I think studying history can give you very important lessons for how markets are changing today.
Yep. The
econ side was a little bit more, I'd call it exercises, not problems. That's sort of my distinction. Exercise, it can be fiendishly difficult. You're solving an nth degree Hamiltonian.
Yeah.
But the answer is known. Problems, I define as you have incomplete information and you won't know if you're right until later.
Yep.
And I think a lot of our higher education fails to prepare people to solve real problems.
Yeah, and that's the real world. One of my observations in venture is that I think that across great entrepreneurs and across great leaders in business, two degrees that have stuck out to me as from my viewpoint at the time of being overrepresented were both history and physics.
Yeah.
I think history gives you the grounding of, okay, what has happened in the past, obviously, and then physics is helping you understand how systems work to solve a problem.
Yeah.
So I always think that's interesting. So UChicago, then to Bridgewater. Bridgewater is a great experience. And then what did you do after Bridgewater, but before Opto?
Yeah, spent about 5 years at Bridgewater. Great experience. Can't imagine a better thing out of college and just the depth of the training. By the end of my time there, I was doing a lot around like risky credit. And so high yield and emerging market debt. And saw from that vantage point that being able to just predict supply and demand for borrowing the economy was mattering less and less for trading high yield because so much was moving to the private market side.
Mm-hmm.
And so I got very obsessed with that space and how you could apply a more systematic framework like we use at Bridgewater for public markets to help people tackle the beast that is private market data and what to do about it. Yeah, very brief stint at a firm doing secondary venture shares. Sort of knew it was not going to be a permanent stop. Met Joe Lonsdale pretty soon after leaving.
Mm-hmm. And this is 2020 timeframe?
Yes, yeah.
Pre or during pandemic?
Just after. So I think Joe and I met maybe 3 weeks or 4 weeks after it started. He had early access to some blood tests for COVID, so I'd go to his house, prick my finger, wait 15 minutes.
Yeah.
We'd go on a run together, have lunch. Actually ended up being good timing because he's usually on the road. You know, he's flying around the country every day, but he's stuck at home.
Stuck at home, just like everyone.
So we would hang out, minimum 2 or 3 days a week at his house and sketch at the whiteboard and play pickleball and Magic the Gathering and, talk about markets in between. So, then joined, 8VC does their build program. So a few companies a year where they've identified a spot that there is an existing company they want to back, and usually an angle where like institutional grade backing early will be a big competitive advantage. And so what are the companies that won't really work as a garage startup that won't?
Yeah, $5 million isn't going to get you very far.
And so this was one of those where you need balance sheet, you need to register as an RIA, you need to get big talent in pretty quickly. And so, worked on this as part of the build program and launched October of 2020. Yeah.
I think Joe helped start Adipar, right?
Yeah. It was one of the founders, or the founder. Yeah.
Yeah. And, and prior to that, obviously Palantir. And I think the through line there is like having institutional support across both of those very different types of businesses, but in both of those industries earlier on is probably more helpful than not.
Yeah. And I think a through line there as well as that problem space is just generally seeing the need as data grows to get beyond the spreadsheet.
Yep.
How do you make linkages live? How do you give the right people in organizations the right view onto their piece? And that might be a totally orthogonal view to someone else, but they agree. That was the Palantir problem, and I think applied really effectively to the Adifar problem space of how do you just understand what's out there in markets. It's actually harder than it should be.
Yeah, it's massively hard. So that's your experience. Let's talk a little bit about Opto. Ground for the listener, for the viewer. What does Opto do?
Again, Joe and I met up and we're seeing different lenses on the same problem. I was seeing the sparsity of data, how hard it was to have a sort of systematic view. And as chairman of Adipar, he was seeing just how rare it was for fiduciary organizations to have a really robust and scalable approach.
Mm-hmm.
Sort of seeing based on work that Adapar had done, based on other changes in our industry, that this was possible now. One thing we always look for is like, what's possible today that wasn't possible 5 years ago?
Yep.
If it was possible 5 years ago, there might be a good reason it doesn't exist.
Mm-hmm.
Whereas with this, you didn't have the data layer that you had in 2020, and no one had really caught up to making this really work for fiduciaries. And so, the goal is pretty simple of how do we make private markets work for investors versus having investors just be another distribution channel for private markets.
Mm-hmm.
And the primary way we work with clients is we help build custom exposures. So funds that can be, it doesn't mean growth fund, income fund, a co-invest vehicle. It can get highly specific. It can just be a broad, hey, this is the best of private markets.
Mm-hmm.
How do we build that specifically for your client base, where they're at in their wealth journey to meet those goals? And then through setting up that centralized unit, how do you flex the institutional power that you can have across your whole RIA or across all of Opto's network to get into the best funds, the best deals, and structure a portfolio that works through time?
Are you primarily creating bespoke fund-of-fund products for your
Primarily, definitely that's probably 80% of the core business. But also, so it can be single asset, it can be a fund of co-invests. Honestly, most common is a blend of the two. Identify 5 to 6 great managers and have 30% reserve to do co-invest alongside them as that scales. And you can imagine both from the GP and LP side how hard that would be to do without a structure of often the best co-invest, you have 2 weeks to turn it around.
Yeah.
The minimum check size is going to be $1 million. Like most individual investors don't have the capital and should not, from a portfolio construction perspective, like write that large check. But if you're writing your $1 million check into a fund where that's going to be 5%, that starts to make a lot of sense.
Yep. How in practice does this work? So let's say I am King Street Advisors. It's me and my 4 buddies. We manage $3 billion of AUM, have a team of 20 or so, whatever it is. How do I interact with Opto? Because obviously I'm talking to my clients every day. I know, Joe's an entrepreneur who made his money in software. Sally is an entrepreneur who made her money in the fitness industry. Kyle is an entrepreneur who made his money in oil field services. And they're all like, private credit, maybe I've heard of it, maybe I haven't. Venture capital, I don't know how technology works. Like, how does it work in practice as they are still operating as the front end for their clients and you are still helping them basically enable their clients to get access to all these different asset classes?
I should start with one big difference between us and a lot of our competitors is we don't accept payment from GPs. And so we don't have like this.
Yeah, you're not Blackstone's external fundraising arm.
Which is what a lot of our competitors boil down to. And so there's a trust that comes with that. I'm not here to sell you one exposure. I'm not getting paid to overload this thing. So that means we can start with a really goal-oriented conversation of let's go through the client list. Let's go through not just current clients, but where you're trying to grow. What mix of assets is going to be most accretive to their wealth and also best for you as an RIA to help grow and tell your story. In parallel with that sort of investment management conversation, we have automated processes for spinning up all the legal documents, getting the structure, integrating into reporting and custody and CRM so that once the fund is live, it's really easy for the internal staff to use. But then it's a back and forth of this is their fund. We are here to due diligence, portfolio construction, sourcing. But because we're not paid, it can come from anywhere. If they have 2 funds they've worked with for 10 years that they love, we'll re-diligence them and they can be included in the fund as well. And you probably want to iterate a little bit with your top 5 to 10 clients, make sure that this is scratching whatever itch they might have. And then we do a lot of advisor education, filming videos, putting together the right collateral to help make the story make sense. Then you launch your fund. You can fundraise for a year, and then usually you'll launch vintage 2 after that.
So me as King Street Advisors or whatever I said, it's like the King Street Fund.
Yes.
Wow. Very cool. Very cool. What now I'm just curious, what like fund structure is it under?
So the easiest and simplest is under the 3C7 exemption. And so that would be QP only, but is pretty much unrestrained in what it can do in terms of underlying and how you manage that. We do also run,
when you're screening potential RIAs to work with, you specifically seek out people who are only work with QPs. And also for the audience, Can you quickly explain the difference between QPs and AIs?
Yeah, so there are actually three relevant distinctions. There's one in between that is a lot of people don't talk about, but is relevant here. So you have qualified purchasers. That's $5 million investable net worth or above. So really anything that doesn't include your primary residence. Mm-hmm. There's a credit investor. There's a couple ways to qualify, but I believe the most recent is $200,000 a year in income, or
you can work at
a knowledgeable place, or there's some asset threshold that
I think it's still $1 million.
Yeah. Then there's qualified client, which sits in between AI and QP, which is either $1.1 million with an advisor or $2.2 million overall. So that middle bucket, and because it's small, a lot of people don't talk about, but is relevant here. Yeah, we definitely tilt towards firms that have a high QP percentage, but there are other structures we can employ to let people move down the book. And so you can run a fund as a 3C1, lots of letter and number combinations.
That's 506C, 506B,
Big D, yeah, all the that one you can allow qualified clients and qualified purchasers in. You just have a 99 investor slot limit.
Yeah,
so that can be a little bit tough because if you're trying to let in smaller investors, their checks are probably smaller.
Yeah,
but you have a cap. So we see some of that for the right firm. It can make sense. Where we're doing more is actually helping clients create their own registered vehicles. And so tender offer funds or interval funds, which then would be perpetual in life. And you can let in any level of accredited investor or higher.
Lots of stuff to talk about. I want to talk about the evolution of private markets and even your initial insight into that, because from our seats, you entirely live within private markets as an industry. I dip and dabble outside of it, but from where we sit, there's growing interest of how do you bring private markets to the individual investor. But I would still probably say we're only in like the first, second, max third inning of that journey. So I want to talk more about that. I also want to talk more about how you all are using automation in the entirety of your workflows, because a lot of it does sound like legal structuring and operational lift. How are you using automation, whether that's deterministic software or software using LLMs? How are you using that to drive operational efficiency within your business? Because there's a lot of complexity on just the operations of setting up these different structures.
There is, but it's actually a problem that if you go deep enough, I think technology is actually really well suited to tackle. And to take the first step in the process, which is often like you need formation documents, you need legal work to define this structure. Historically, if I go to a outside counsel, and look, there's some firms that are better than others, but many will basically pretend like this is the first time they've ever done this. We're going to go from fresh cloth. It's going to be 20 partner hours. It's going to be very expensive. It's going to take a long time.
That's their business model.
It doesn't seem very aligned to me. I'm more, an equity guy, but, but you can take that and say, really, how many ways are there to do this? How many risk factors are there that you'd have to put in a PPM? Well, if it's 25, what if you just pre-wrote those and pulled the right ones in? Mm-hmm. Minimums, share classes, fees, all these things can be pretty well defined. You don't even need an LLM to build that system. You need a simple form field of like 15 entry points, and you can get a pretty good first draft of the legal documents back in an hour. Yep. Just given the risk, it still makes sense to have an outside counsel review those, but now you're talking about an hour of review time and you're done in 4 days instead of a month, and it's kind of unlimited budget. Yep. On operations, setting up, via Stripe, Plaid, et cetera, a bank account for the fund that can integrate into the bank accounts of the customers or through custody. Thinking about pre-populating subdocs, most of that information is going to already be in CRM or your reporting platform. Mm-hmm. How do you pull that in such that when someone logs in to check out, 99% of the work is done?
So you guys integrate into Redtail, Wealthbox, Salesforce, whatever they use.
Whatever custodian, whatever reporting provider, and once you get that set up, you can unlock a lot of value. You don't have to go through in your head and say, who is this relevant for? You can use our portfolio construction software, and it can say, here are the people with the biggest portfolio gaps. This solves. Mm-hmm. And then it can auto-generate a proposal of the right amount for them this year based on how cash flows work and what we expect in terms of pacing.
Yep.
And based on that number, you can repopulate the subdocs and send them out. We've had people go from 0 to 50 clients in less than an hour.
Yep. Very impressive. I'm going to ask this question, then I'll ask you about the history of kind of how you've seen private markets evolve. One thing that I'm observing in this AI moment, right? ChatGPT launches November 30th, 2022. That's the starting gun for everyone. You obviously have businesses like Harvey that come out of the gate immediately. You have businesses like Rogo. You have businesses like Glean. A lot of companies are occupying this like co-pilot like space where it's like, hey, we're going to help the RA, the advisor or the lawyer do work faster, the investment banker, whatever it is. Then there's another leg of companies, which are these businesses that are filling an outsourced service where it's in the legal space. You may have a demand letter that needs to be generated if you're in personal injury. In commercial real estate, you may have, if you're a broker and you want to sell a building, you may have to create an offering memorandum or another product. And there's businesses that operate as this outsourced service and say, hey, I'll go to the business and just throw that work over to me. I'll do it. I'll be more efficient by using AI, and then I'll give it back to you. And then there's businesses that kind of operate this full stack space where they're saying, and some of these businesses have been started and founded pre the AI moment, but they say, they take the approach of, you know what? I want to be the advisor end to end. I want to own the client. I want to be the residential real estate brokerage like Compass, and I want to own clients end to end, or I want to be a business like Savvy or Farther, do the same thing in wealth management. It kind of strikes me that you sit in the middle. Like you are this outsourced service for the RIAs, kind of one part like capital raising and diligence partner, one part legal structuring. And I'm just curious, how do you guys think about yourselves internally within that paradigm, or even has it even come up, or is there another way that you guys think about how you guys are positioned?
It's a great question. Here's how I think about it. Our view is the human is not being disintermediated in wealth in anything like a 10-year time frame. There's too much, even if it just boils down to you're someone's money therapist, like that's still something I think a lot of people who aren't financially savvy want to have a human on the other side of the phone who they can call when they're scared and who can understand their situation. Our question is more like, how do you build the Iron Man suit for that person? And that can be a mix of technology, team, and process. I think where we try and sit is not forcing you into any one of those buckets ex ante, but saying like, what is the right approach for that space right now? And of course, as technology grows and evolves, like you may increase surface area. But for us, like a pretty traditional compute, it doesn't require an LLM on the like auto-generating legal docs based on priors. Like it's great. And it is also great that we have a good legal team who can explain that to a human being on the other side. And I think if we didn't have that human in the loop, or an RIA who's never built a private fund before, I think that'd be kind of terrifying. Versus there are places where we have started going really deep on verticals for generative AI. And so one big scale problem a lot of people have is screening. There's diligence overall, but there's also, and I probably get sent 50 decks a week, and I might be on the low end for a lot of allocators. Like once people know you put money to work, you end up getting a lot of things sent your way.
Sorry, GPs are sending you the deck? Okay. So it's like I'm
raising money fund.
Yeah.
Take a look.
I'm long leg capital. I want to buy up SMBs and whatever. I'm a search fund. Yeah.
And I hear that Opto allocates to funds. So here's my materials. And the simple truth is no human is going to handle that much information on a real-time basis. And so just internally, about 2 years ago, we started building tools for our investment management team to tackle that more efficiently. And so how do you, whenever you receive a deck, just forward it to an alias, use Gen AI to rip out the information, build a actual security master. Here's everything I know about in the space. Here's all the data I know about it.
Yep.
You then get to start asking pretty cool questions like, what's the average written cap rate I saw in real estate? Or what's going on with venture valuations over all the deals I've been sent?
That's super valuable. Do you ever get excited about, if that's occurring, right, of exposing that data to third parties, whether that's on the LP side, to your advisors, or even to the broader allocator community?
Yeah, and so we actually launched a software product just last month, essentially doing this and offering that tool we built internally to institutional allocators.
Yeah, they have the same problem.
They have the same problem. And look, you want to defer to like what the specific NDA you have in place with a manager for really sensitive data, but most people are sending around decks, no problem. And I at least know everything that's out there. But we've rolled that out across some, several of the top endowments in the country, some sovereign wealth funds, and they have this problem at that larger scale I've ever seen. thousands of potential things to screen a week. Of course, your team is not going to be able to work through that. And so if there's a tool that, we let people set up pretty intelligent grading criteria of like, hey, here's where I want fees to be, but they can go this high, or I want this kind of manager background, this network and venture, and get back really quick. It's not a good no-go from like a full diligence perspective, but it kind of answers the question of like, should I spend my time here?
Yeah, give me a first pass on, I don't even want to say judgment because it's a little bit of a loaded term, but give me a first pass on, give me the analytics that I would consume to help me make my judgment-based decision.
Yeah, and we take it one step further where, again, the AI layer is just getting so good here. When we onboard a client, we'll have them send us 12 to 15 example investment committee memos they've written, train their specific instance to write that memo, and then you upload the documents, and 10 minutes later, you'll get a memo back, and it'll just highlight, hey, we almost always include this sort of operational vendor check. Of course, that's not in the documents, but now the analyst is like, I have my first pass and I have the 3 areas I need to go dig in deeper.
Yeah.
And so the general feedback we're getting is what would have taken someone 8 hours takes 30 minutes. And think about the scale that gives to any team, but also like a smaller team in an RIA, they don't have a dedicated private markets person, but all of a sudden they can move as fast as some of their institutional peers.
Especially in the worlds we operate in, things are very networked. And so that client, the smaller RIA who has the client, that client has a buddy. And they're going golfing, they're going snowboarding, and they're doing whatever they're doing in their life. Yep. And someone's like, "Oh man, I just invested in this company that XYZ private fund backed, and they returned Y for me." And then they're gonna hear that, and then they're like, "Why am I not in that?" Wow. Let's talk about the so we're jumping around a lot, but let's talk about the evolution of private markets. How have you seen this progress over your career? Did you even personally, when you were at Bridgewater, were private markets on your radar? Were you trying to put personal capital to work? What were some of the problems that you observed that then gave you conviction to want to build a business in this area? And then let's talk about how the world has changed from 2020 to now.
So Bridgewater, they're definitely on our radar. We needed to have a full view of the entire capital ecosystem, which increasingly included private markets, but it was never something we did directly. I mean, our mandate was
global macro,
liquid hedge fund, need to be able to put on trades on time spans of anything from a week to a year, but you're not going to be getting in and out on that time frame in private markets. So it was something we tracked and we knew about, but was not a core focus.
And from a fundraising perspective, you guys were institutional, so raising from sovereign wealth funds.
Yeah, there's 300 players in space, XL clients, not a mass play. That said, we did do research on behalf of our clients. If they found a private equity deal, we would certainly chase that down and understand it backwards and forwards and get back to them with our read on them as a manager. Doing some stuff we now do at Opto. How do you look for, does this have systematic biases? Like I might start with the sort of naive assumption that a lot of private equity looks like 2x long small cap time minus 1x short the level load index. I'm borrowing and I'm buying small cap companies. Mm-hmm. An initial screen I might want to do for any private equity manager is, did you beat that combination? Mm-hmm. If you didn't, or if you looked a lot like it, I shouldn't pay 2 and 20. That's not alpha, that's beta. Mm-hmm. And so seeing early things like that and just the growth of this space, which we can talk more about, I was pretty convinced there was something big to do here. And look, the growth of the space makes sense. Post-financial crisis, you get rates to zero for a decade. You get massive bets of QE, huge amount of growth of the real money sector, long-only investors with a lot of money to put to work. And I'm sure you talk to people in this all the time. If I can raise the same amount of capital at the same valuation from the private side, why, as a founder, would I want to go public? It's maybe an ego thing of ringing the bell, but like I'm adding 30% compliance cost a year. I now have to manage my business to next quarter's earnings. Like there's a real advantage to staying private. And so if the capital ecosystem is there to support it, it's not surprising to me that we've seen the growth we have and seen company timelines to IPO extend and see private credit grow. Yep. What came with that, though, was what used to be an access problem really isn't anymore. And so, in 2005, there were only so many private equity funds, and they were raising all their capital from endowments and sovereigns, and likewise, they didn't need to take on the problem of having hundreds of or thousands or tens of thousands of NLPs. But that's changed. Both the overall size of that market has grown so much, and most of the institutional investors are now at their sort of policy maximum for where they can go.
40-50% allocated to alts and privates.
It's a big difference to take over your sovereign wealth fund from 0 to 50 than to like try and get them from 50 to 55. Mm-hmm. Plus, there's very little DPI right now. People usually use DPI to go back into the same fund. And so where that's left us is a lot of GPs have realized that to continue to grow their businesses, they're going to have to work with the wealth community. What I've observed is that the wealth community has not quite realized how much the power has shifted in their favor yet, which is part of what we help them flex. You are not lucky to get into a Blackstone deal now. Like, that is not the problem. There are managers who fly under the radar and are oversubscribed. They still want to raise from wealth, so that's where we help our clients on sourcing. I think there's still too much of a scarcity mindset in the space, and like the truth is every GP knows that if they're going to grow and be big, they have to work with wealth. Now, they are not yet really working for wealth, and so that's where we come in.
On the allocator side, what average GP size do you work with? Like, when do people, first-time managers, I don't think are going to the wealth community unless they're doing like hand-to-hand combat.
Well, yeah, they're not. We work with first-time managers. They are through us. Probably not like someone who's never done this before, but a super high-quality spin-out from like the best team at a PE firm. Like, we love that stuff.
And is that like because I'm trying to think about portfolio construction for them. Let's say they want to raise $300 million, which I would argue is pretty large, depending on the asset class, like relatively large. Are they thinking, hey, I'll raise 60 from the wealth community and I will help, Opto will be one of the vehicles that helps me raise that?
Yeah, I'd say probably around that ratio for right now. But I'll add that for a lot of the GPs we work with, they're sort of happy to have Opto be their only entry point into wealth. Like, because we operate through these custom structures, they just see a single check from an institutional GP and they see our diligence process. Mm-hmm. They would work with one of the platforms that's a menu business. They might have to get on 120 calls with various RIAs around the country over a span of 2 months, and like they just don't have the team to support that. And so a lot are opting to just say like, this is going to be my wealth channel thing with Opto, and I'll leave the rest to the bigger funds that Blackstone can hire 500 IR people.
Yeah,
I can't.
Right. Super fascinating. So you've seen this evolution. I love the insight of, hey, the wealth community hasn't necessarily fully realized the advantaged position that they're in, because I do fully think it's the opposite. But, when you look at, investor days and quarterly reports from KKR, Blackstone, Apollo, they're all like, this is who we want to go after. And so it's certainly an interesting period.
And they're spending a massive amount to do. I mean, the growth of the sales and IR teams to target wealth at those mega firms it's just massive spend, and most GPs can't compete.
Yeah.
And so, you asked the question about average size, but like we definitely, both from an investment management perspective and an access perspective, favor smaller issues. That it depends on the asset class. Like in venture, we are certainly talking sub $1 billion, but often sub 300 million raises. In private equity, 500 million to a few billion. In private credit, probably sub 2 billion. And when you're talking about like mega private equity funds or $20 billion raises, we're trying to fly at a lower altitude, which allows, because like the investment teams of these shops are not that different in size. Mm-hmm. And so if I have to put 20 billion to work over 12 months and I have a team of 15 people, like I'm going to focus on large deals.
Right.
I can't do the $100 million loan size. I need much bigger tickets. You're leaving a lot of money on the table. A lot of the best performing loans are probably not going to be just to Fortune 400 companies.
Yeah, there's going to be some compression no matter what. What do investors, I realize we're talking about a ton of different personas. What do clients, like individual investors, advisors, clients, what is the gap? Do they care about, and I observed this when we were at Cadre, a lot of high net worths, whether they're QPs or AIs, they make their money off of doing one thing, and that's what they know. They may not be super sophisticated. Most of the time, they're not super sophisticated in financial markets. And even if they are, they may have only made money off of private credit, and they're like, I don't know how to underwrite venture.
Yeah.
People very returns focused, and you put the best return in front of them, they do a little bit of analysis, and they just make their judgment call. Or is there a lot more investor education that needs to go on in terms of saying, hey, you're going from a 60-40 portfolio to a 50-40-10 portfolio, and within that 10 portfolio, you should have this exposure to private credit, this exposure to venture, this exposure to private equity. Here's why, and then here's why these managers that we've wrapped together work for you. Like,
yeah. So I think there's two answers here. One thing you didn't mention, but is a real dynamic advisors have to be cognizant of and play with, is there's also just like the name thing of
I know Blackstone.
Yeah. Well, that and the exciting side, like, can you get me OpenAI? And you can debate, is that the right way to play that right now? But like, there is a.
Sorry, before you go on, would you invest in OpenAI at $500 billion?
500. I probably wouldn't personally, given my return profile. I'm not saying it's a bad investment.
Yeah.
But when I'm doing venture, I try and talk myself into like, what is the path to 10x at least?
Yeah.
And just there's a denominator problem.
Yeah.
Not to say they couldn't get there, but it's just there are opportunities I'm seeing that the 10x is a much easier thing to hit.
Yeah, there's a bet on your dollars, risk adjusted, better to place it elsewhere.
Yeah. Now, like, I think there's benefits to being in the flow and seeing stuff, but it's just if I had $1 million at where I am in my age and journey, like, I'd focus on, maybe on a single basis, more risky, but smaller checks to ideas that have a little more upside.
Yep.
Because a lot of, some of the clients made their money in financial markets, but a lot of doctors, lawyers, dentists, like, they're reading the Wall Street Journal, they're reading about private companies, they're asking, like, do I have access to this? And you have to play, the RIA's job and ours in helping them is like, how do you balance excitement with reality, and how do you explain often by the time it's on the front page of the Wall Street Journal, it may be a little bit late. The best thing, which has happened a few times for us, is you're in a year before and then they're very happy when it ends up there. But then to your question, so it's that sort of mimetic interest in just what's going on and being a player in the fields. There is definitely, I'd say, for a lot of people who are in the QP bucket, growth is more important than income. You probably aren't, spending all of your proceeds every year.
Yeah.
And you're thinking about legacy and philanthropy and stuff that higher growth would help. And then there is an income component. I think that's less relevant today with yields where they are, but certainly when yields were at zero, how do I get something to juice cash return?
Yeah.
But to your point on education, I think that is the most important thing. And even, you said it this way, and not to pick on it because I think it's a very common mindset, but breaking the idea of like, hey, taking 60-40 to 50-30-20 or whatever, like, there's two ways to own things. You can have a debt claim or an equity claim. And it's almost like dispelling the public versus private distinction. If you don't think you're going to touch this money for 5 years, it doesn't really matter to you if it's public or private. The question is like, is this a good way to capture growth? Is this a good way to capture potential alpha?
Yeah.
And so we try and help people think more in terms of like their core fundamental risks. And it's very Bridgewater framework of like, what are the factors that matter to portfolios and how do these help me diversify those and get to a better state? Big piece of that is alpha. I mean, the difference between top and bottom quartile for, say, like the long short equity community is 4 or 5%, depending on the year. Mm-hmm. Difference for top versus bottom quartile venture capital is 25 to 30%.
Yeah, I was going to say it's wide.
And so if you think you can end up, say, in the top third of those people, like there's a real return over beta and a real, potential to generate robust returns even in a down market.
What feedback do you hear from advisors on presumably advice you give them to think about things from debt and equity claims rather than public-private? Because that makes a ton of sense to me, but it's new, or at least for me, it's the first time I've heard someone describe it that way.
It's a process, and like our goal is not to totally like throw out the whole playbook they're using, like multiple ways to slice this, but it is just to try and say, hey, if you're thinking about alternatives as one bucket, you might say, hey, I want to move 10 or 15%. But if you started with the other lens of if I was starting from scratch, how would I capture economic growth? How would I capture income? How would I capture alpha? you'd get to a different endpoint than just like, how do I shift today's portfolio?
Mm-hmm.
And so there's a lot of education. How do I zoom the camera back, get goals oriented? And, depending on the structure, think about how much liquidity really matters to me. One thing I always go back to is like, people talk about illiquidity as a risk. It's a risk if you think you might have to spend that money. If you are gearing up to buy a house, probably don't lock up most of your net worth for 10 years. It won't be available. If we're talking about money that you are going to invest anyway, my view is it's actually a lot less risk. Like, how long does it take? And you see this all the time working with founders and companies. Like, how long does it take a good idea to really come to fruition? It's 3, 5, even 7 years. And for that company to have to manage to a daily mark, to a quarterly report to the SEC, to the public market scrutiny, I think often distracts from their mission and makes it less likely they'll achieve it. And so my view is like, if you can tolerate illiquidity, there's less risk in tapping these ideas with locked up capital than with capital that can flee.
Well, on the flip side, you have much less visibility.
That's part of the data thing. That's part of our role, is the visibility is getting a lot better. And it's our job as their fund partner to deliver that visibility. You should have full look through. You should be able to see every company you're holding. Yes, they're not going to mark daily and there'll be a lag, but you can use an intelligent understanding of how factors work, how public market proxies work, to give people insight. And often it prevents you from your worst behavior of you don't panic sell because you can't.
No, you can't. You're locked in. Let's use the last kind of 8 minutes or so to talk about, where is Opto at today? Where do you want to go in the near future, right? We've talked about the evolution in private markets. We're talking about how you guys are using automation in your own business. I would love to kind of get the update on the current state, as well as, again, where do you want to go? And also, one thing I am curious, can you tell us a little bit of the story, or as much as you can, about the Series A raise? Because you guys, my understanding, when I was doing the research, I was like, wow, that's a huge Series A raise before the huge Series A raises. So yeah. Kudos to you all.
Yeah. So, where we are today, we're fully invested in this core business of setting up these custom offerings, growing really fast there. And the biggest change there is our ability to offer those tender offer interval fund evergreen structures in the same sort of format. That's an area I'm excited to see grow over the next few years. Because I think a lot of people have been accepting pretty subpar off-the-shelf offerings in the semi-liquid space. But being able to build your own purpose-built semi-liquid fund for your clients, I think, is a huge opportunity for a lot of RIAs, and a way to bring in your accredited investors and your whole book into a single sort of model portfolio world. Really excited about this AI diligence tool we've launched. The traction so far has been pretty crazy. Crazy enough that we already have 3 roles posted to just be the service engine behind that.
Oh, great.
Because turns out people have been wanting the service for a while. And then we're also doing some really cool work on really advanced sort of cash flow and risk analytics. There's a whole difference in how, if you're used to public market world, you just see daily returns. It's not that for private. You see capital calls and distributions. Mm-hmm. How do you turn that into a holistic view that you can incorporate into the whole portfolio? I see all those things coming together over the next year. They really should tie out. If I get a distribution from my VCs and it was above expectations, that should feed back into a risk engine that tells me here's where I should redeploy those dollars, mm-hmm. and ties into my diligence engine and says, and here's the 3 funds we've seen. It doesn't have to be going back into venture. It could be solving a portfolio gap in credit, but I've already lined up the 3 credit managers that I've screened and I should look at for that distribution to plow back in. I guess more generally, though, what I am excited about driving change for here is, again, making these markets really work for the wealth community. And so things like a bunch of funds are not structured for taxable investors. You can make them relatively tax efficient, but they've been built for endowments that don't pay taxes. And so basically no infrastructure funds work in a taxable account, but could you structure them such that they do? Yes. We're starting to get to a point of our scale where we can influence the GP and say, we love your approach, but you need to build a product that works for our clients. Similarly on data, I want the PDF to not exist anymore in a few years, at least as it pertains. If I were to put a bunch of people in a room and say, come up with the worst way to send numerical information, they'd probably come up with something like the PDF. If I'm going to have a number.
Same more, yeah.
I have a number. I'm going to take a photo of that number. That photo may or may not actually be parsable. I'm going to send you the photo.
Yeah.
And then on the other side, you're going to look at the photo and try and manually copy the number into your spreadsheet, even though it was just in a spreadsheet on my side before.
Yeah.
So as an industry, we need to move away from paper processes. And the bigger we get, the more we can ask managers to really play ball in terms of how their data is sent to us.
Yeah.
And some of that is, hey, Gen AI is getting a lot better, so you can't extract from PDF very easily. But we should get to a world where information flows much more cleanly, similar to what Bloomberg did for bond markets in the 80s, we want to do for private markets.
Yeah, why take the step of unstructured to structured output? Just give me the structured input.
Yeah.
And I'll go, and I don't do
ain't
anything. Yeah. Yeah. That's funny. I like that. That's a spicy take. So last two questions. One question is, for people listening, people watching, what do you want them to know about Opto, or how can they help Opto in y'all's journey of building? And then the final question is, and I love asking this because I think this is the ethos, especially of the tech industry and the tech community. Knowing what you know now, if you were to advise a startup founder wanting to build in private markets or any other fintech, AI, whatever it may be, what would you have wished you knew at the start of your journey?
I'll do the first one first, but there's a lot of answers to the second question. The question is always like, which of those did you have to learn as battle wounds versus could you have learned? But on the first question, look, anyone who wants to see the private market industry improve, be that an allocator, be that a GP, be that a service provider, we're very partnership forward. We don't believe we have to own every step of this or every piece of this. Yeah, we're highly collaborative. Anyone who wants to build a custom structure or think about accessing the wealth community in a high quality way, we are here to do that. And then particularly on that new diligence AI product, anyone who has that scale and screening problem, reach out for sure. And we're still in a really exciting part of that build where it's super collaborative. We want to hear from our clients of like, what are the most useful exhibits they usually generate? What are the questions they make sure to ask? How do we build it to spec for their process? On the lessons learned question, a ton of lessons. This has been an education you can't get any other way, for sure. I think the thing I would tell myself to really lean into is just getting really close to clients really early. If you don't, and like we got there, I think we could have gone there faster of getting to the heart of the problems people are experiencing. And I'll actually answer your Series A question as part of this. We had an incorrect assumption that we needed to put up a few years of performance before people would trust us to structure their funds for them. And to do that, we were like, well, we have access to great flow. Let's raise a large balance sheet and actually like set up essentially a warehouse where we'll pre-allocate and it's not a best efforts feeder. It's we're putting $12 million into this manager, and later on, if someone wants in, they can have it.
Mm-hmm.
Took that to market, got good, but not great traction. And the common thing we heard was like, I just can't have another 8 subducts for a single investor. Doesn't scale with my business. I'm trying to grow my RIA, and this is not a scalable process. I need you to structure it. Mm-hmm. And so we always wanted to get to the custom fund business. We incorrectly thought we needed to put some time up before that was feasible. And if we'd been much closer to the real operational challenges early on, we might have skipped that step. So get really close to your clients, really understand the pain points. And then I think it's always, it's the classic Henry Ford thing of like, if you ask someone before the car what they wanted, did they say a faster horse? How do you both have that feedback loop really tight, but not just build the grab bag of features? Mm-hmm. And that's the tightrope we have to walk.
Yeah, it's really tough to do.
Yeah.
Really tough to parse out what someone needs out of what they say they want.
Yes.
Very tough skill.
And even beyond, like, I find often our clients don't think big enough. And maybe it's that, look, I think that we have the best engineering team in this market right now, and they've been used to a different experience, but like they'll ask for, the 5 inches when they could ask for 5 miles. And so also being able to then zoom out and say, yes, we can solve that problem, but what if you didn't even have to do that at all?
Right. What if you never had to open up a PDF ever again?
Which they can now do if they just forward the PDF they get to the service. And so it is that balance of how do you stay so close to what the client really needs and be ruthless in meeting that while acknowledging they might not know to ask for the real killer feature.
Right. Love it. Well, Jake, thanks for coming on. So appreciate you coming on to talk about Opto.
Of course. Fun.
Great.
Appreciate it.
Awesome.